Great. Thanks, everyone. So thanks for joining our financial year 2023 shareholder meeting. The intention of this is to recap both the year that we just finished, which is our 5th financial year as a fund, and do a little bit of commentary on the market and what we believe lies ahead. So as I said, one last time, questions, please put them in the chat. We'll be collecting your questions throughout the presentation. I will try to keep this to 45 minutes, so we have about 15 minutes for Q&A at the end. So today I'm joined by my co-host and my teammate, Scott Stevens. Scott, please introduce yourself.
Hi, everyone. I'm sure we've all interacted in the past, but if we haven't, then I look forward to interacting in the future. And I'm ready for this shareholder meeting.
Great. And so most of you, as the intended audience of this presentation is our existing shareholders. We consider you our investment partners. I'm sure we've chatted as well. Once again, my name is James, and I lead the investment side of the organization at Hosper. So without further ado, we'll get underway. I'm going to kick it over to Scott and ask Scott to share a few comments at the beginning of this presentation.
Yeah, absolutely. So we thought we'd kick this presentation off with a little bit of an educational session on the regulatory background of our business. Not a lot of investors really know what goes on behind the scenes with regards to the regulatory side of things. So we figured it would be important to kind of just give a little bit of information on that end. So you can see here from this slide that it starts out with our authority or our governing body. In order to sell shares in Ontario, whether you're going through a prospectus public entity or through a private entity like ours, you have to go through the Ontario Securities Commission. So the Ontario Securities Commission is who governs us on the selling of shares to investors like yourselves. Now, in order to be a licensed agent to sell these shares, you have to be what's called an exempt market dealer. An exempt market dealer is licensed through the OSC and is a licensed body which is allowed to sell shares for private issuers like Hosper. So I myself am licensed through our exempt market dealer, which is SMV Capital Markets, also known as Front Funder. And that allows me to have conversations with shareholders about things like eligibility and whether or not they should invest in certain products. So that's kind of the regulatory side of things. With regards to our new relationship with SMV Capital Markets or Front Funder, about halfway through the year, we transitioned from our old exempt market dealer, which was Belco. I'm sure a bunch of you have seen documents with Belco listed on them. Going forward, everything's going to be done through SMV Capital Markets. So yeah, this is just a little bit of a slide here on what you will see when you transfer your data or your onboarding side of the investment over to SMV Capital Markets. It's all brought centrally through this new platform. So everything is digitally stored here. It's much more secure. There's less interaction with personal emails. So all the documents are signed through here. We're very proud of this software. And if anyone has any questions relating to how they get onto this new system, definitely reach out to me.
Yeah, I think that the two biggest wins coming out of this transition is cutting down the time that we need to ask from you with respect to maintaining and updating what we call in the industry, know your client information. So we have an obligation to collect it upon initial investment, but also to make sure that it remains current. So using this digital platform, it will really reduce the time spent to transmit and collect that information. Also, with respect to IDs, there's a lot of great technology out there that does digital verification. So using your address, your legal name, they can do a digital ID verification check that regulators are happy with. And this is so much easier than asking you for 2 photocopies of your driver's license and passport and utility bills and tax bills. So we've really cut down the time that we're going to ask you to spend. With that said, there will be a request to many of you who are new and not yet on this platform to make the first step to get onboarded. And so Scott will be reaching out over the next few weeks to take any shareholders that had transacted recently with Belco and bring them up to speed and onboarded to this program. So we're looking forward to that, and we appreciate your help with the transition. Many of you have attended one of these annual meetings before. If you've seen any other of our webinars, we've talked about our purpose. So of course, the main focus for this audience is to investors, but of course, it's an important reminder of what we are to our three different client bases. So of course, to brokers, we want to be perceived in their minds as the best alternative to a traditional bank. So we want to be the first thought if a home trust or an equitable bank cannot fund their client's mortgage. We would like to be the first private option they consider. And of course, for borrowers, we are a more flexible, we want to be a high level of customer service for our borrowers who have a temporary need for private financing with Hosper. That's just a recap of what we are. With respect to the mix specifically, just want to, we're proud after 5 years to show you our slow but steady progress. What this works out to basically has been a slow and steady climb. Since inception, we've raised about $1.5 million net per month. So that's been just a constant, steady journey for us, accumulating. Obviously, you can see the red line is our total AUM, but it's very important to distinguish the fact these are three distinct funds. And I'm going to make this comment very clearly. While it's one, you are shareholders of one MIC, one company. There are three distinct funds within that entity. So there are three distinct portfolios. Often we just talk about the totals for shorthand, but it is, to be clear, if you're a shareholder of Class A, that's very different than being a shareholder of Class B or C. Okay, and so of course the fund that we started with, which is now currently our balanced fund, this is the largest. This is the A class, the one in the middle. And in 2020, we introduced share classes B, also called our comfort fund, and share class C, our high yield fund, to give investors more choice. We're just going to go ahead. Julia, if you could just make sure everyone's on mute, we'll just continue on here and talk about some of the changes we've made this past year. I think the biggest changes to underwriting started in 2020, but with respect to the mix specifically, we made some additional changes in 2023. So currently, we've instituted sort of, what should I call this? Self-imposed maximums on the loan to values we're taking into the fund that are even below what has been prescribed for in the offering memorandum. So we're just taking a bit of a scale back on what has always been our maximum. And currently, we've also taken a position that we want to max out on loan sizes. So we've always had an understood maximum that no single borrower would borrow more than $1 million from the fund, and that's just to limit any concentration risk. We've also instituted a cap for seconds of 300,000. And other changes this year have been, of course, an increase in rates. So that's been, we in the private mortgage investment space are a direct beneficiary of an elevated interest rate environment. So many of you, like me, have a mortgage, and maybe you're feeling, maybe you have a variable rate mortgage, or you're coming up for renewal and you're feeling the frustration with elevated rates. We, as the lenders here, get to be on the other side, and we are, of course, a beneficiary of the higher rates as it pertains to yield and the return, and we'll be getting into that in specific numbers. But what I think I want to make clear is the duality of factors going on in the interesting year like we've had. Elevated interest rates mean higher rates of return, mean more borrowers needing Hosper type solutions, as it's harder and harder to qualify for traditional banks where rates are at today. It also does pose some uncertainty and some risk to the economy at large. So you have these two forces. We're seeing a great abundance of quality deals, more quality deals than we've ever seen in a single year. We're seeing higher pricing despite the fact that loan to values are lower, but at the same time, we're seeing a forward-looking uncertainty. And we're seeing a market that's 15 to 18% off its peak, which peaked early 2022. So we're dealing with the implications of that as well. So certainly a very interesting year with forces going in both directions. As we will have more time and certainly spend a lot of Q&A time focused on forward-looking, but I think first I'd like to look back. And I just want to highlight a couple of the major milestones. Many of you have been shareholders since inception of the fund or since the first year of the fund. So it's really quite exciting that when we set up the fund, we created a 5-year roadmap. And in September of this year, we reached that milestone. So the fund has now been in existence for 5 years, has a 5-year track record. And some other important milestones to note along the way. Of course, the introduction of Scott on our team in March of 2022. Scott has been the lead person, my right-hand man when it comes to onboarding and helping and assisting investors joining the fund or asking questions about redemptions or payments. And Scott, of course, is joining me today. Also, in October of last year, we changed our model in light of the fact that we were exceeding our targets. So in 2021, we managed to achieve a profit surplus that was distributed to investors, but was only done so at the end of the fiscal year. Going forward, we changed that to a monthly distribution, and we'll be getting into that a little bit more detail with this, how that appears in the statements. But certainly, as many of you have been shareholders throughout the year, you would have seen two separate deposits appear on your statement every month, which one reflecting our target dividend, which has been achieved every month, as well as the surplus payment that was made. Other major milestones, Scott already touched on the upgrade to SMB Capital and the efficiency that's had for both our onboarding and our Know Your Client upkeep to make sure that we always are maintaining up-to-date data. Lastly, I would like to touch on, what else do I want to touch on? We talked about the 5-year anniversary. We have a great partnership with BMO that's been working very well. We're very happy with our banking partners. And of course, in November, which is the material in this presentation will be as of September 30th, 2023, because that's our fiscal year end. But looking now as of November 2023, just last month, we surpassed 80 million AUM. Actually, we've actually surpassed 90 million, should actually say 90 million AUM. And looking forward, 3 areas that I want to touch on from a growth plan perspective. Number one, we've recently had a new member of the team join Hosper. This Massimo, this individual has tons of experience in the mortgage industry, and we're very excited about this addition because this will allow us to further expand our broker network. Those of you that have tuned into other webinars, you know that, of course, there's 2 sides. You as collective shareholders and our investment partners bring the capital, but without mortgage deals, without the origination side, there's no business. And certainly origination is the most important aspect of what we do here. And we're excited to be adding another BDM to help grow our brand within the broker network. Certainly looking at the numbers too, we're also seeing projections that we're going to be reaching a target of 120 million under management in Q2 of next year. That's expected. And lastly, we have plans underway to launch our own exempt market dealer. So we've talked about these 2 great partners that we've had, one being Belco Private Capital, another being SMB. We've now reached a scale where it just makes sense to bring this in-house, still maybe leveraging some of the technologies that we've used along the way, but bringing in our own chief compliance officer. Doing that dealership work internally is just going to allow for a more seamless experience for our investors. I just want to remind everyone, if you have questions throughout, if anything comes to mind, please just go ahead and type it in the chat. We'll be spending the last bit of the presentation answering your questions in real time. So here we are, as of September 30th. So that's, again, our fiscal year end. We had 84 million under management, 84.7 actually, with 407 active loans and 317 active shareholder accounts. The latter 2 numbers to me are just as impressive as the 84 million that we've achieved. And that's because of the level of true diversification that offers. So with over 400 loans, with over 300 shareholders, that gives us diversification on 2 fronts. So loans divided by AUM, that tells us our average loan size. And so a loan size, an average ticket size around 200,000 has always been our target. We've always felt that was a reasonable trade-off with, enough of investment in each deal that we're not taking too small of pieces that are insignificant and administratively burdensome, but without betting too much on any one deal. In fact, we don't have a single loan in our MIC that's larger than 2% of the total portfolio. And that's really important because if you look at private funds, specifically private real estate funds that have gotten into hot water in the last 10, 15 years, there's a common theme that you'll see, and that's concentration risk. If you're a $100 million fund and you do large scale construction projects, and one of your projects is $15 million and something goes wrong with that project, that's extremely material to the fund. And so that level of diversification that we've achieved, I think, is just one of the safeguards that is protecting the fund today. So I'm not going to go ahead and read out. Hopefully you've been able to read out all the other aspects that we wanted to point out. Now I'd like to spend some time just to break down and distinguish the three share classes. So again, Class A, kind of our flagship fund. This was the first fund we launched. This is the balanced fund. So currently, while it's had a permanent long-term target return of 8%, this past fiscal year, we delivered just a hair under 9%. And I'm strongly confident this year, if everything continues on the trends that we're on, we will exceed that 9% return in the Class A, and more on that later. The other equally important metric is the average loan to value that we've been able to manage across the fund. So this fund in Inception and the way that it's described in theory in our offering documents, we had an intention to keep the loan to value under 75% in the fund. And certainly at 61%, we feel like we've quite succeeded that objective. And I do bring that up because, I'm frequently asked the question about return and how we are poised to deliver a return above our target in an elevated interest rate environment. And what I want to say there, I don't want to give the whole thing away because I've got a slide on this later, but we could deliver a 10% return. We could even deliver an 11% return, but that would be getting away from the objectives of each of our fund, which is let's deliver the target return or marginally above the target return with the lowest risk possible. So what we've essentially done here is we brought down the risk profile of the fund by doing a number of things. First and foremost, loan to value, bringing that down, increasing the number of first mortgages, keeping it above 70-30 in favor of first mortgages. And of the 28% here in second mortgages, the average loan to value on that is well below 60. And also urbanizing the portfolio. So you'll see more loans in very vanilla cities. We've just created the objective of the fund to have as many vanilla, cookie cutter, simple loans as possible. And that, in our opinion, makes the fund stronger. Now, to distinguish that, so again, just to be clear, the majority of our subscribers have chosen the dividend reinvestment option. So that's what I've described here, the 8.95% with the DRIP. Without the DRIP, it was close to 8.6. I believe non-DRIP returns might even exceed 9% this year, the way that we're seeing things trend. And what I mean by that is the average returns and average LTVs in the fund shift slowly over time. So with the size of the fund that we have, every week you have new mortgages discharging, or new mortgages being funded and others discharging. So it takes time to shed old loans that might have been renewed, that might be 2 years old, that are still at 6.99% rate, which would have been our typical rate 2 years ago. But as more and more of those loans are shed from the book, and as more and more new loans are being funded at 8.99, 9.49 at current rates, that blends up the average return in the fund. Same theory applies with loan to value. As we're shedding older loans, older deals that might have been done in the 70s of loan to value, and replacing them with loans in the some cases 40s and 50s, that's bringing down the average loan to value over time. Okay, so that's why there's really sharp corrections in the prime rate, but then slower adjustments happening in the yield of the portfolio on the private side. Scott, do you think I missed anything? Would you like to add anything on this note?
No, I think I think you've touched on everything there. We're going to get into the benefits of DRIP, dividend reinvestment, a little bit later on. So.
Okay, great. Thanks, man. So Won't spend too much time because these are the same material. This is the same material for Class B and C, but just to show you the difference, of course, our Class B, our comfort fund, a nice green circle right there in the middle. All that is, that pie chart just shows 100% first mortgages. That's the objective of the B class, and an astoundingly low loan to value. So a loan to value well below 50%. This to us is our attempt at making the safest possible GIC comparable risk product, risk return type product. And of course, this would be, of course, a higher risk product than a GIC, but of course also a higher return product without biting up too much risk there. And then lastly, our Class C, this is our attempt at taking someone who historically has invested in second mortgages and likes that double-digit return, likes the second mortgage exposure, but then giving them the benefits of the fund, the benefits of loan loss reserve, the benefits of the diversification, the benefits of more liquidity, the benefits of not necessarily being obligated to renew and having your investment not tied to a single loan. And so I see Class C, I see the return of Class C expected to rise throughout this year as well. I don't know if we're going to make it to 11%, kind of grappling with that because, as we get north of 10, my main prerogative is to reduce the risk in the pool rather than increase the return. I think at a return north of 10, we're certainly exceeding our 9.5 stated target. And I'd rather deliver, let's put it this way, I'd rather deliver 10.5 at a much lower risk than 11 or 11.5 without adjusting the risk down in an uncertain time. So that's where we stand on that. And now I'm going to pass it over to Scott to really hammer home the value offering of the D.R.I.P program. Scott, over to you.
Yeah, absolutely. And I'm just going to throw something in quick relating to the previous slides. But essentially, what I like to say is that the way we want to structure this for investors is through three things. We want to, one, protect your principal. Two, provide above market returns, and three, provide a good service. If we can do all three of those things, we are extremely happy as investment managers. So reiterating what James said there, everything we're doing is going to be, one, to protect that principal, then two, to kick over that extra yield, and then three, hopefully we can provide you with a good service. One of the ways to increase your yield is going to be on the next slide, and that's going to be through our dividend reinvestment plan or program, also known as D.R.I.P. I just want to take some time to reiterate to investors how powerful the tool of compounding is. I totally understand if investors, are relying on the cash or want that cash to supplement a lifestyle. And if that's the case, then monthly cash payments are definitely the choice for you. But if you're not relying on that cash or you don't need that cash, there really is such a powerful opportunity to take advantage of the monthly compounding. Not only are we rolling over the surplus on a monthly basis, you can, because we pay out monthly, which a lot of MIC investment funds don't do, you can compound monthly on your shares. So essentially what the D.R.I.P plan is instead of getting the cash, you're getting the value of that cash in extra shares. So you can see from this chart here that a simple investment of $100,000 over I believe it's a 30-year period, would end up at $340,000 with simple interest versus $1 million and change using compound. So you can really just see how powerful that is, especially over time.
Thanks, Scott. Yeah. So I think this is where we're going to shift into talking about sort of the main things that we look at from a fund specific perspective. So we've touched on most of these, but let's specifically address them. So first would be our excess profit. So the way that a MIC is structured is as a flow through. The owners of these portfolio of mortgages are the shareholders, the preferred shareholders, yourself and myself as a shareholder myself. And so the way that a flow through works is it has no profit at the end of the year, no net income at the end of the year. Everything is flowed through. So if we have surplus after paying the target dividend, after covering the expenses, and after setting aside a loan loss reserve, something needs to happen with that excess. We either need to charge a management fee, or we need to cover other expenses, or spend more, I should say, or we can simply pay it out as an additional profit surplus to shareholders. And so that's what you've seen over the last 2 years. if you've been a shareholder with Hosper. You've also seen our loan loss reserve grow. So there's a whole slide dedicated to loan loss reserve towards the end of the presentation. But what this is essentially, in layman's terms, is our emergency fund. We're setting aside today's profits for a rainy day tomorrow. And the objective with loan loss reserve is not always bigger, it's not always better. Accurate is better. And so we have a very simple analysis tool that we use to try to create as accurate of a loan loss reserve as possible, needed in each of the three portfolios. More on that in just a moment. And then lastly, I think I'm in a market that I've experienced really proud of the fact that our default rates are higher than they've ever been, but really low relative to industry standards. So within Hosper, of the 7 years that I've been running this business in mortgages and managing private mortgages, this hasn't definitely been the year where we've seen the most challenges with respect to defaults. And it's not what you might think, not what intuition might say. I think the natural assumption is that defaults are people can't pay. What we're seeing, and look a little bit behind the curtain, is really what's happening in the market, both housing market and mortgage market. So banking market all the way to private market. And what I mean by that is, first and foremost, private loans, not just at Hosper, but in generally all MICs, are given based on a loan to value ratio. And from 2022 to 2023, we've seen pullback in most markets in Ontario, anywhere between 15 to 18% from peak. So different markets, Brampton versus Ottawa versus London, might have had different months where they had peak and might have had different months where the data has trended over time. But from off peak, it would not be unusual to see a property 15 to 18% off its peak value. Now that poses real challenges if that mortgage was taken or that property was appraised closer to the peak. That client was appraised for or was given a 75% loan to value mortgage or an 80% loan to value mortgage at that time, but that property value has declined simply because the market has declined. It'll be really hard for that client to refinance, regardless of their payment history, regardless of their quality of home or ability to credit score, any of those factors. It's just they're stuck because of their loan to value. And clients in those situations are either forced to renew, and that's one reason we've seen an increase in renewal, or pay down their mortgage. And naturally, it's tough for someone who's already taken a private mortgage or sometimes a private second mortgage to have $30,000, $40,000, $50,000 of cash accessible to pay down the mortgage. So that has created one of the reasons that we're seeing an elevated default rate. Another reason has to do with other industry participants. So historically, the number one way, this still would be the number one, but certainly not by such a landslide this year, that clients are exiting their mortgages would be to use our loan as a temporary runway, as a 1 year, 12-month runway, do the things they need to do to graduate back to an institution. Graduate back to a bank, they graduate to a lower cost capital, we get the principal returned, and we provide a loan to somebody else. Now, as banks' rates are elevated, banks have more strict and stringent lending criteria than before. It's harder for borrowers who are in the private space to make that leap to the bank, to exit. It's the inverse of the same force that is benefiting us, seeing more and more clients need a Hosper type solution. So on one hand, the fact that banks are really stringent, really turning away what we believe is still great business, has benefited us, as our deal flow is more than it's ever been, and we're able to only cherry pick the best of what's being submitted. The flip side is it's harder for our clients in the private space to exit back up to a bank, as for the reasons we just discussed. And then the same would be said for clients looking for other private borrowing solutions. So historically, if you consider Hosper as a private lender on the risk spectrum, we would be at the low end of the risk spectrum as far as private lenders go. So there's many other private lenders that historically did deals, like approved deals that we declined. In other words, they would have paid out deals that we were not comfortable doing. Those lenders in some cases have scaled back their risk appetite as well. Just meaning it's harder for a borrower out there. There's more borrowers looking for private financing and harder for them to qualify. So these are, again, two diametrically opposed forces playing against each other. One is positive for the business, one is negative for the business. Hard to say which force is winning, but it's just important to be aware of both forces and understand that we factor those into the decisions that we're making from an underwriting perspective to a renewal terms perspective to a payout perspective, okay? And then lastly, I think something that should be highlighted, something that we're very proud of in the 5-year history of Hosper, is that we've never charged a management fee on the fund. Anyone that's invested in mutual funds, common to expect a 1 to 2% management fee. Other MICs also commonly would charge a 1 to 2% management fee. So how does it work? Hosper needs to make revenue to operate our business. The unique benefit of Hosper is that we are both a money manager in the context of the MIC, but we're also an originator in terms of the traditional business, the business that many of you got familiar with before joining the MIC, the direct mortgage business, where we are providing lending solutions to borrowers. Deals are submitted through mortgage brokers. The MIC is a vehicle that we created to be able to do our main business, which is providing loans and managing those loans, to scale more effectively. So we don't need to charge a management fee on the MIC side. We use the MIC and we pay the cost to set up and operate the MIC to be able to originate and fund more mortgages. And we collect a fee every time we successfully close a mortgage. So certainly there's some MICs out there that also have the same model, that are originators and make origination fees and also charge management fees. That's completely normal. That's completely acceptable. We, in fact, even in our offering documents, have a provision for that 1% management fee that could be eligible. We just continue to make a decision that as this is a product, this fund is something that we're intent to scale. We want to flow through as much of the returns to either the loan loss reserve or the distribution surplus. So we've taken a position. It is not solely out of the generosity that we have. It is admittedly a business-driven decision that we want to have the best performing private MIC in Ontario for what we do. And ways that is measured is by loss rate, loan loss reserve, and return relative to risk. And so by not charging a management fee, it really helps us hit it out of the park on those other three factors. And then certainly the origination business that I described, that you're familiar with, sustains the business and has got us to the scale that we're at. We talked about generating the surplus. This is, as you can see, the returns have been quite steady over time. Returns climbing in the latter 2 years. And Scott's going to just use this excerpt from a monthly statement to illustrate exactly how you can see exactly how much you've earned on a monthly basis in both the target dividend as well as the surplus.
Yeah, so I want to start out, just by saying that if you're not getting this statement, please do reach out to me, give me a call or shoot me an email, because we want to make sure that all of our investors are reading through these statements. They're very important. They show a lot of information about your investment, your year-to-date figures. You can see everything, and most importantly, you can see what you're getting paid on a monthly basis. So just looking at this statement right here, the first line just above the highlighted line there of $679 and change, that line is going to be fixed to our targets. So for Class A, we're fixed to 8%. That number might fluctuate month to month. It's depending on how many days there are in the month, but it is fixed to 8%. Then the second line, the highlighted line, is going to show that distribution. That is going to be variable on a month-to-month basis, and it could be anywhere from 75 to 100, 125 basis points above that fixed rate.
Great. Thanks, Scott. Yeah, good point. There are some folks that don't even know they're not getting the statements issued with their email. So if you're not getting a statement, we want you to get it. Please let us know. So we just have three slides left. Without getting into the nitty-gritty of the loan loss reserve, I just want to highlight this point. Again, the objective of loan loss reserve is not just to grow the biggest loan loss reserve possible. That would be not prudent. That would be withholding dividends or payments that should otherwise be paid to you as a shareholders on a monthly basis to buffer the fund. Under provisioning or under allocating money to a reserve would also not be prudent. That would be paying to you more at the expense of protecting the future ongoing nature of the fund. So what we do is create, we use a pretty simple algorithm. It's a pretty simple equation, and it determines how much money per loan we should be setting aside as a provision. And we use a simple equation. Is the loan in good standing, or is it in arrears, or is it in power sale? And what is the risk of that loan should it go into power sale? So simple equation, do that 408 times for all the loans in the portfolio, will determine what our loan loss reserve should be. So actually, as of today, we've added more to the loan loss reserve as we calibrated the numbers up. We're sitting at, as of today, so this is LLR today, that should really say loan loss reserve September 30th. That's where the balance was at the fiscal year end. As of today, collectively, there's just over 700,000 in a loan loss reserve. So to really crudely explain and use simple numbers, very soon our fund will reach $100 million. Around that time, I would expect the loan loss reserve to reach roughly $1 million. And so what that means is we could suffer 1% loss. 1% of the loans could take complete losses, or we could lose 1% of the money on principal losses, and it would not even yet impact the return target, the return that we've paid. So again, imagine $100 million fund. For context, to date, we've had 0% losses in the fund, but imagine we now had 2% losses. So imagine next year, $2 million of write-downs and principal losses. First, the 1% that we've provisioned, the $1 million of loan loss reserve would get fully utilized. Then the next 1% would come off of the return. So that return that we're currently projecting to be around 9% would go back to the 8% target, and so on and so forth. And so if we had next year $10 million of principal losses. So 1 in every 10 loans is a complete loss, complete wiped out, which is really hard to do with first mortgages. But for the sake of this theoretical argument, imagine that. Now we have not generated a positive return, but we've yet to have any principal loss felt by the shareholders. We just failed to pay a positive return. If we go beyond that, that's where the risk of investing in mortgage and mix exists. That's where there would be a potential risk to principal loss. So your $1 per share would, in the theoretical terms, would get written down to 99 cents per share, 98 cents per share. So that's just to show the margin of loss that we can accept, that we can tolerate, that in fact we expect or have provision for before we reduce the return. The return, the positive return, the roughly $9 million positive return the fund will generate, then is the next buffer, if you will, before principal loss occurs. There's questions of that, I welcome them. Last note to touch on is the enforcement rates. So roughly the same as last year, bouncing between 3 and 4%, which is certainly elevated. Mid-COVID, we were all-time low at sub 1%. Previous to that, we were hovering around 2% for a long time. Certainly, there's funds that are still good investments, still safe funds, still funds that I would not be afraid to have my money in that have 8, 9, 10% enforcement rates. Because again, remember, enforcement rates does not equal risk of loss. It just means that they're loans that are not in good standing, so they need to be worked out. But certainly proud of the fact that our MIC has a low enforcement rate. It is actually lower, I'd say it's lower than that of our DMI portfolio. And that's mostly due to the fact that the MIC we've sort of self-selected the lowest risk loans into the MIC. And that's why there's higher yield on the direct side. So continuing and just wrapping up the presentation here, we're at 5:45, so I'll just wrap it up and then we'll take some time for questions. I want to interject and say I didn't even mention that we are coming to you, Scott and I both coming to you from our our brand new office. Mid-October, we finally moved across the street from our old office to new office space that we share here with Richardson Law. I mentioned that because this was actually another big milestone for our organization, and we're very excited because we're planning a open house in the new year. So stay tuned for that. So that was a milestone that I wanted to touch on that I forgot. And then to wrap it all up, just to sort of talk about, we did talk about without getting into specifics, I talked about looming uncertainty. I think if you read articles, there are very, there's no doubt that interest rates have been topic of the year. And there's, of course, positives with the way that interest rates have moved. Inflation seems to be coming to check, but certainly there's extra inventory being added to the market. There's lots of stuff happening economically. So that remains quite a lot of uncertainty. But really the things that we can talk about in specific, the returns have been increased above target. Loan to values have been reduced below target, both positives. Enforcement rates remain below our target threshold. Loan loss reserve remains in line with what we are projecting is required. We've yet to draw down the loan loss reserve, and we have seen an increase in urban properties across the fund. So all of these things are ways that we're just slowly, like I said, week by week, slowly shifting the parameters of the fund. So without further ado, Scott, do you want any last comments, or should we hop into the questions here?
No, I think you covered everything there, and I'm ready to jump into some questions.
All right, so we got a couple questions here. Okay, so I'm just going to quickly scan them just to make sure that I don't active investor, loan loss reserve. Okay, great. We have 3 questions here, which should take us to time. So we'll try to get out of here by 6. The first question was actually submitted in the sign up, which is a fair question. What can I expect for 2024? To be determined, of course, as the year continues, but I'll tell you today, we just finalized the rate of return for the November distribution, and November is going to be across all 3 funds, our highest return ever in all 3 of our funds. And that exceeds last month in October, which was also at that time our highest return ever in those 3 funds. So what is happening there is that trend that I described. Old loans at lower rates paying out, new loans at our new higher pricing being funded, bringing up the average return across the fund. It's written on the screen there, but just to add, if I add my own kind of flavor of don't quote me on it commentary, I would say I would expect the A class to be in the 9s, the B class to remain in the mid 7s, mid to high 7s, and the C class to exceed 10. If rates continue to rise, that might reach 11. If rates do not and rates start to come back down, I expect it to remain in the 10s, with the main objective of the C class is just to de-risk. So the C class, being our high yield fund, is our most aggressive fund, funded mostly by second mortgages. So we want to de-risk that fund as much as possible. We want to reduce the average loan to value. So hopefully you can plan accordingly with that information. Active investors wants to set up, I'm going to pose this as a question to you, Scott. So Scott, if we had an active investor who wants to set up an additional investment account for their grandchildren, the investor will be the owner until they reach the age of majority. What's the minimum? How would you answer that, Scott?
Yeah, absolutely. So I'm just going to read into this for the reach of age. Okay, so yeah, I mean, we can definitely look into setting this up for you. Our minimum is stipulated at 60,000 and 30,000, depending on which fund you go into. Now, with this said, if you're looking to set up an account and have that accrue some earnings for your grandchildren under your own name, if they're not of the age of 18, then we can definitely look at setting that up to add on to that. Once they do become the age of 18, if you wanted to transfer it into their name, that's something we could certainly look at doing. I would recommend that anyone that's looking to do this for one of their children or grandchildren that is of the age of 18, strongly look at one of 2 accounts. One would be the tax-free savings account, and the other would be the first-time home buyers account. or a first-time home savings account. Those two accounts are going to provide you with the tax advantage of allowing those investments to sit there and accrue without having to pay taxes using that dividend reinvestment plan for a long period of time. You can do the calculations on how the compound interest would work in your favor, but an investment that starts at the age of 18, like I wish I could have done that at the age of 18. By the time you're in your 30s, 40s, buying that first house, you're going to have pretty substantial gains or earnings in that account, which would then be able to be used, whether it's for your house or you leave it to the age where you're retired and you're looking to then take those gains out tax-free when you retire. There's such huge benefits to starting those accounts at a young age.
Yeah.
So I definitely recommend any investors looking to do that, reach out to me, and we can look at setting up those accounts for you.
Yeah, so as Scott mentioned, 30 and 60, that's our typical minimum for a new client. If this is an additional investment for a grandchild, we would consider this a subsequent investment for yourself. So we're able to negotiate like much lower minimums. $10,000 would be worth it probably. You let us know what we want. I mean, honestly, what you're trying to do, I want to support. So we are happy to do this on a smaller scale. What I view this as is more of a cool teaching tool to teach your grandchildren about investing in the power of compound interest more than the couple $100, maybe a couple $1,000 they're going to make each year. So we're going to support this if this is something you want to do. Just let us know and we'll help you with the paperwork. What is the LLR running for Q1 of this current year? So again, thanks, Julia. By the way, kudos to Julia for putting in these slides together in real time. So thank you very much for that. We actually have different figures, Julia, for the loan loss reserve today. So as of, that says LLR today, but those were our figures as of the end of fiscal year. Let me see if I can pull those up really quickly and tell you what they are verbally. I know from looking at them today with our finance manager, Sam, they were collectively just north of $700,000. So we've seen an increase in all three. That's because as of Q1 this year, so as of October 1st, we changed our parameter slightly. We just added a couple percent in that ratio that I described, that calculation. We increased the amount we want to set aside as a reserve. So we've increased our baseline. So each loan has a slightly larger amount, and that's why as the fund grows, we're taking a larger loan loss reserve. So as of today, just over 700,000. I wish I could access this for you immediately, but it's in and around. I'm going to use really, really crude numbers for you here. Roughly 500,000 in the A class. Again, that's because it's our largest fund. Roughly 200,000 in our C class, and our B class remains small. It's still less than $40,000, and the reason for that is we don't feel the need to provision much. We don't expect, even in the event of enforcements and those files, we don't expect to incur principal losses. So if that is all, I'm going to
James, there's one more question. I think this next one here we should address. This is definitely something I think a lot of investors would be curious about.
Great, yeah, absolutely. I'll take this one. So, how would Hosper MIC respond to a hypothetical real estate market decrease of 10 to 25%? Yeah, great question. Certainly, the high end of that, 25%. I'm gonna operate on the assumption that we're talking about 10 to 25% from now, which would mean 25 to 40% off peak. The relevance there is let's put a benchmark here. So 1991, the late 80s and early 90s was the largest pullback in values that Canada has ever seen in real estate. Many of you would remember these times. Their interest rates were high teens. In some cases, borrowing rates from banks were low 20% annualized to borrow on a mortgage. Property values over the course of several years dropped as much as 30%. And I throw in the caveat: impossible to say a single number when talking about a Canadian landscape, because different markets respond differently, different asset classes respond differently. I digress. What we've seen right now is a 15% off peak. What we are preparing for at Hosper is anywhere from a 10 to 15% further decline. That's sort of the way that we're bolstering the fund. If we see a 25, 30% decline in real estate, it will be tough. It will be tough for our business. It'll be tough for the market at large. That alone should not lead to losses in any of the free funds. Certainly, the C class in the face of a 25 to 30% market correction would be the most impacted, because those are loans where we have only roughly 30% of buffer to begin with. We have on average loan to values around 69%, right? So if we have 30% coming off the peak there, that doesn't leave a lot of margin for error left. Again, I've read a lot of doomsayer forecasts. As you stay really informed in this space, you sort of start to observe the biases of certain authors. And I think that even the most kind of pessimistic ones I haven't really seen credible projections or commentary that sort of expecting below 10%, more than a 10% decline. I feel like almost obligated to pause to just say nobody can tell you what that's going to be. I don't even try to predict or project. I just try to tell you what we're trying to prepare for. So looking at the A class, for example, 15%. Again, we see much of the same that we saw this year. Likely an increase in enforcements, more clients struggling to pay out, more clients needing to renew, and more of the same. Now, if we see a 10 to 15% rebound in property values, if we see interest rates start to decline and activity return to the market, we're going to see a reversion back to the mean. We're going to see more of what we saw in 2020, 2019, which is more clients actually successfully graduating out of privates, into the bank financing. So bit of an opaque answer because there's so many factors at large. But sort of to summarize it up in one sentence, a 10 to 15% decline is something that would not catch us by surprise, and would be something that I say that we're sufficiently provisioning and preparing for. Perhaps we leave it at that, and I think that is probably brings us to time. So we're 6 o'clock now. So thank you so much for everyone who's joining. For those of you who are not actually yet Hosper shareholders, you must be on our mailing list. Thanks for sitting through this. Scott, of course, is going to be reaching out to you to follow up and see if you have any more questions. We are welcoming new shareholders to join the fund. I wish everybody a very happy holidays. And when we post the day of our open house, I hope to see all of you here at our new office. Would love the chance to have the face-to-face. On that final note, actually, we are going to make an effort beyond just the open house. We have a plan for 12 events next year, 12 investor events. We've experienced it. It's been great when you have been able to come meet the growing team in person, meet each other in person, enjoy some social time together. So not only look out for the invite for our open house, please look out for the invites to all of our shareholder events. And I wish to see you there. Have a great evening. Bye now.